Hey, it's Soleil, and this is episode 103 of the Orange Pill Investor. I'm going to do a quick recap and illustrate some of the annoying whipsaw scenarios that can go down selling covered calls. It's all a part of the strategy. It's really not that big of a deal. It's kind of annoying, like swatting away a mosquito, really. Um, And I would actually say the biggest mistake I made was just using margin right from the beginning. I should have waited for some dips to dip into the margin. But so I would like narrowly avoided a margin call last week, and so I rolled a couple of calls out to May 31st, and the strikes were kind of low because I needed enough premium to cover the margin shortfall. And so now the the stocks, so Riot is like $2 over the strike price, and Hut is not too bad, 35 cents over the strike price. Mara, this is the original one. I got rid of CLSK and picked up this one. So the 18 strike is in good shape so far, but this Mara one is underwater, like $200. But it is nice to see that the MicroStrategy is rebounding as well. I'm basically changing my strategy a little bit with this account. Usually I would take cash and buy more shares of the stocks that I'm trading, but I'm using MicroStrategy as my store of value. And when MicroStrategy pumps and I have enough here to sell 100 shares, to buy 100 shares of something, I'll do that. Now, granted, this is worth probably $1,000, so I could get 100 shares of something, but I really want to wait for MicroStrategy to pump before I do that. And not only that, but I still only have $1,000 of buying power. Now, granted, it does say low risk at this point, but this melted very quickly over the last couple of weeks as Bitcoin and the mining stocks all dropped. So everything's a trade-off. So, and the reason why the premiums are so high in these Bitcoin mining stocks is precisely because they have to compensate you for this risk. So I'm missing out on like $50, $200, 250, $450. So my account would be up to $4,000. I would have basically doubled my profit this week had I not carried covered calls. But the up plan is the same as the down plan. So regardless of where this lands, I will probably allow these to go 2 or 3 weeks so that I collect the extrinsic value from each of them. And depending on what happens to the price over that time, this could cost me, quite a bit. It may cost me quite a bit to roll. I mean, just for the heck of it, let me just see what would happen if I try to roll Riot now to next week. Can I just roll to, yeah. If I tried to roll to next week, I would end up losing like $250 here. So I'm going to wait 2 or 3 weeks and let whatever extrinsic value I can roll out of this call before I roll it. And may end up having to just let this ride all the way, much, much closer to expiration. I generally do not prefer to do that, but in this case, I may have to if I don't want to pay for that roll. In the long run, then again, it may be to my advantage because I can collect more per week doing weekly than I probably can on the 45-day expiration. However, I don't want to get whipsawed again and then hut crashes back down to 7, and then I'm rolling here, and then I'm paying to buy back here, and then I'll be rolling again and paying to buy back. So I will probably let these ride for a couple, 2 or 3 weeks, and I'll just continue to trade the Mara weekly, and I'll buy more MicroStrategy with the Mara profits. Yep, that's a winner to me. But just want it to be known that I'm not. I do bang the drum on selling covered calls. I think it's better than buy and hold. But in the event that you do choose a stock that can be volatile, this is the type of stuff you may have to deal with. But I still prefer the guaranteed profits per week that I let snowball into larger profits for the year, rather than just sit on my hands all year long and watch the price of my stock do this. And I'm just along for the ride. I'm clinging to a piece of a piece of driftwood, and I'm just getting knocked around by the waves. I just can't trade that way. Some people, maybe they're just Zen or whatever, maybe they meditate and they can just DCA into index funds and whatever for 30 years and then look and see what they've got. But I enjoy active trading, and by my calculations, the benefits of being active vastly outweigh missing out on a couple little spikes, here and there. So that's my update. I don't want to make it seem like this is just an easy I win button. I do think it's better than buy and hold. I do think it's better than, just sitting on index funds and dividends. But there are weeks like this where you're happy because, this went from $3,000 to 3,500, but you're still kind of eyeballing like, oh man, I left some profit on the table or whatever. But that's just short term, not really FOMO because it already happened, but it's just like a short term disappointment. But over the course of 52 weeks, 2 years, 3 years, 4 years, 5 years, the weekly profit taking adds up. And so it'll be fun to see how this works out and see if I can still get the 25K in 4 years on this small account, even after like it crashing 40% within the first 2 weeks, because I bought all these mining stocks at all-time highs, at Bitcoin's all-time highs, and then of course there was some pullback. All right, I think that's a nice little just short update now, illustrating the I guess the pitfalls of this strategy, and you have to be mentally prepared for that. If you're looking at this and it just eats you up inside because you chose the strike, but now the price is $11.50, then yeah, just buy and hold, or not financial advice, but do whatever lets you sleep good at night. This is what I like, and it served me well. So, all right, that's it for now. Be good, y'all.